Welcome to part 6 of the video titled KPMG Hedge Accounting Manual or Book. Till now, part 1, part 2, part 3, part 4, and part 5 are done. And till that January, we are done with the complete understanding of the hedging. Why do we need to take the hedging? What are the three forms of hedging, which includes the cash flow hedging, the fair value hedging, and the net investment hedging? What are the implications of cash flow hedging? What are the implications of fair value hedging? And cash flow hedging can be done in deliverable part and non-deliverable. So would be the fair value hedging, which can be done in deliverable part and not deliverable part. Now that is up to the corporate treasurer ability. I haven't discussed the instruments, which could be forward contracts, which could be options contracts, which could be non-deliverable forward, which could be non-deliverable options, which could be non-deliverable OIS, non-deliverable FRA, forward rate agreement, non-deliverable CCIRS, cross-currency interest rate swap, non-deliverable swaptions. So would be the deliverable. So that I haven't discussed. But keeping this as a backdrop, one thing which is very clear and straightforward is that there are two things. One is known as hedging instrument. There are numerous hedging instruments we have in the world. We have forward contracts, plain vanilla option contract, exotic option contracts, option payoff, structured payoff, overnight index swap, basis swap, Quanto swap, reverse Quanto swap, ratchet Quanto swaps. We have CCIRS, cross currency interest rate swap. We have FRA, forward rate agreement. We have many forms of hedging instruments. And the hedge accounting, I repeat, the hedge accounting of all hedging instruments are completely different, and so would be the impact on the EPS. By EPS, I mean earning per share. Gone are the days when company used to report EPS only as basic EPS. No, that is not completely true now. Now, companies are reporting three forms of EPS. Number one is the basic EPS. Number two is the diluted EPS, which includes the impact of convergence. And number three is the reported EPS, which is more important now. Nowadays, big corporates of the globe, without quoting the name, they have started using a word called reported EPS. One more EPS companies have started quoting is the adjusted EPS. But the basic issue, I repeat, the basic issue with adjusted EPS is the formula of adjusted EPS is not standardized. Not at all standardized. So you have basic EPS, the formula is standardized. You have diluted EPS, the formula is 99% standardized, not 100%, because there is a concept called convertibles. They are the big issue because convertibles are different in different companies, especially in case of startups, they are completely different. Third is the reported EPS. That is again different, not a standardized formula. And fourth is the adjusted EPS. There is not at all a standardized formula in that regards. Henceforth, when it comes to the hedging instrument, whether this is a forward contract, whether this is an option contract, whether this is OIS, overnight index swap, whether this is a credit derivative called credit default swap, trigger swap, total return swap, single trigger swap, multi trigger swap, and all these, whether this is structured payoffs, whether this is structured derivatives, whether this is forward rate agreement, whether this is cross currency interest rate swaps, the impact of all these are completely different on the hedging instrument. It cannot be the same. So, cross currency interest rate swap, I repeat, cross currency interest rate swap hold two-dimensional impact on the EPS, two-dimensional impact on the EPS. While in case of forward rate agreement, it is one-dimensional impact. In case of OIS, it is two-dimensional impact. In case of option, it could be one-dimensional, two-dimensional, three-dimensional, four-dimensional, in some cases five-dimensional. But let's check the definition of hedging instrument in KPMG book, page number 10, KPMG. A derivative hedging instrument is recognized at a fair value. What the hell is fair value? We'll come to it. On a balance sheet with the changes in the fair value recognized in earnings, other than the amount related to excluding components that are recognizing through an amortization approach. Now, what the hell is that? What the hell KPMG is talking about this? What is fair value? Is this L1? Is this L2? Or it is L3? Page number 10, KPMG Hedge Accounting Manual. Check it out. This is KPMG Hedge Accounting Manual. Page number 10. Because fair value, whether this is IFRS or whether this is US GAAP, it can only be computed using three ways, which is level 1, level 2, or level 3. Now, level 1 is known as mark to market. Level 2 is known as mark to model. Level 3, mark to matrix. Level 3 is mark to model. But what the hell is the definition? This is hedging instrument. Forget what I mentioned to you: deliverable, non-deliverable, forward contract, option contract, OIS, and all these things. Did KPMG discuss that? Not at all. This is called Big Four. This is called Big Four. And this is called the stupidity. This is called absolute ignorance of talent. This is called a technical error by a Big Four. That is why I consistently repeating that the biggest fraud in the world is not LIBOR. It is mark-to-market accounting. This is the biggest fraud we have in the world. Now, what is the hedged item? Like I said, fair value hedged item could be asset or it could be liability. Many Einstein, Edisons, Newtons believe that it is only an asset. They are incorrect. It is liability also. And in asset and liability, sometimes it is both. Let's talk about big players: Goldman Sachs, Amazon, Facebook, Google, Microsoft, Apple, Cognizant, Sapient. All have different treasury policies. Now, all have different treasury policies. Some are hedging only net, which is asset minus liabilities. Some may be hedging both. Like banks always love to hedge both because they have both side positions. They cover the asset, they cover the liability and make money on the either side. Sometimes they do the market making, and sometimes they only act as they are taking the prop position. But having said that, fair value hedging is on the either side, which is asset side and the liability side. But the best strategy, according to me, I repeat, according to me, is to cover both asset and liabilities in a gross way, which is asset plus liabilities. Now let's read the definition of KPMG. Changes in the fair value of a hedged item. What the hell? The title is the hedged item, and hedged item includes hedged item. Changes in the fair value of hedged item that are attributable to the hedge risk are recognized as an adjustment to the amortized cost basis of the hedged item. Super. Fair value hedging is done on amortized cost basis. Super. This you can only expect from KPMG. The offsetting entry is a gain or loss that is recognized in earnings. This is hedged item definition. So I have shown to you that the hedging instrument definition and the hedged item definition both is incorrect as far as this hedging manual is concerned. Both is incorrect as far as the hedging manual is concerned. Because practically, the way the world lives, the way the offshore treasury centers like Singapore, Luxembourg, United States, London, Hong Kong, Dubai, they work. They don't work with this. This is called mismatch between the actual practical treasury market versus these manuals. This is our last part. And then we have one more, which is message. But I hope till now you are very clear on one thing, which is these manuals are completely flawed. And the more we progress in the later stages, the more errors we get, and we keep you posted on our YouTube channel. Welcome to the last part of our video, which is known as the message section, titled KPMG Hedge Accounting Manual. I would like to be very straightforward as far as these big fours are concerned. Apparently speaking, they look like an institution with full of corporate governance, full of check and balances, maker checker principles, full of regulations, full of scrutiny. But the hard reality, we all are aware about it. Even today, there is a website whereby there is some information about one of the big fours, which I would be covering probably tomorrow on our social platforms. When it comes to hedge accounting, which is still one of the gray areas we have in the world, and by December 2023, when IFRS would be mandated worldwide, Basel III would be mandated worldwide, then the same hedge accounting would be a major mess. Reason being, even today, majority of the US banks make their annual report, which is also known as 10K in the US parlance, on US GAAP. But eventually, they have to shift to IFRS, which is International Financial Reporting Standards. And one thing which is definitely sure, as far as the International Financial Reporting Standards is concerned, which is transition, which practically means the transition of hedge accounting from US GAAP to IFRS, which is complicated, let it be honest, which is complicated. But having said that, we really need to learn one thing very substantially. Number one, hedge accounting is completely dependent on the risk management policy of that corporate treasury, rather the board. Now, that corporate treasury could be of bank, it could be of financial institution, it could be of private equity, it could be of hedge fund, it could be alternative investment fund, it could be probably any REIT, real estate investment trust, or maybe whatever. It completely depends because that corporate treasury policy determine what forms of derivatives you can take and in which markets you are allowed to take that derivatives. And more importantly, the impact of immunization is covered on a gross basis and the net basis. Are you allowed to cover only the domestic markets, which is also known as the deliverable market? Are you allowed to cover only, or you're allowed to cover the global treasury centers like United States and many? And if you are allowed to cover a global treasury centers, then which all banks you are dealing with? Goldman Sachs, Citi, JP Morgan, Barclays, UBS, ANZ, Standard Chartered, Westpac, many. Because the limits which these banks are sanctioning to you vary from bank to bank. All banks I mentioned have a different interbank desk. So the level of premium which they offer to you is different. So the level of premium which Goldman Sachs might offer you, probably JP Morgan Chase might not be able to offer you. They might be offering you a little lesser or they might be offering you a little higher. That depends upon the liquidity they are maintaining, which could be prop position, which could be market making positions. Second, the hedge accounting dependent on the type of derivative instruments you are taking. Now, either this is L1, where the observable variable is 100%, either it is L2, where at least 1% is non-observable, or where you have L3, which is known as mark to model, where majority of them is the unobservable. It depends upon the mark to market accounting, because in either case, whether this is a cash flow hedge or this is a fair value hedge, there is an element called reclassification adjustment. And reclassification adjustment is bound to happen. And the impact of reclassification adjustment is nothing but the mark to market. So mark to market would surely be hitting you in the books either ways, which would impact your basic EPS, which would impact your diluted EPS, reported EPS, or adjusted EPS. Henceforth, these hedging strategies should be EPS neutral. And third and very important thing is the hedged item. That is the most important thing. And the ISDA agreement. ISDA agreement means ISDA Master Service Agreements is dependent on both, which is the derivative strategies and basically the hedging derivative and hedging instrument. We also have CSA, credit support annex. We also have RDS. So the hedge accounting cannot be generalized, and ideally speaking should not be generalized. Because if you are generalizing the hedge accounting, then you are doing the biggest mistake of your life. And by the way, the big fours are doing it. And the live evidence is this. Like if you look at page number 11, there is a diagram which is presented about the face value, fair value hedge. Page number 11 of hedge accounting guide. Now, is this diagram correct? I don't think so it is correct. But this is presented by KPMG. Guys, please understand that hedge accounting is very complicated. The more complicated the hedging instrument, the more complicated is the hedge accounting. So don't underestimate this. Let it be very honest. But having said that, it is very interesting exercise also. If we continue to do all this based on the big four manuals, we are not only confused but also misguided. Now, via this message, which I'm about to close in another minute or so, I challenge KPMG that if you think you deserve to be a big four, if you think you deserve to be a big four, if you think that your this guide derivative, which I have shown many times during the video, is correct, then I am right up here. I'm right up here. You can take my phone number, which is 9899242978. I repeat, you can take up my number 9899242978. But please do take a note that we have still left with few people who know the concept fundamentally, who knew the concept fundamentally. I would like to bring this message to the people, those who are chasing the big fours and reading their manuals on Google or maybe the printout the way I'm taking. You may please read it, but use your mind also, because not everything is correct in these manuals. But still, this is Rahul Magan from Hedge Consulting Group. You know my personal number, which is 9899242978. Offended people from KPMG, you knew my number, 9899242978. Have a great time ahead.